Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems for Chapter 7, the short exercises. Um, Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing, and it is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still do not understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so we left off with 7.3 before, so now we're on the short exercise 7-4. Again, it's about preparing bank reconciliations, and this one is about making the journal entry. So it says here, make the necessary journal entries arising from Green Acres Auto Center's bank reconciliation presented next. Date each entry May 31st and include an explanation with each entry. Okay, yep. So here's the bank reconciliation. And remember, we have we have the balance here for our bank and for our books. And since we're comparing one with the other, all right, we find that on our books, we have an entry here for $5. We have an entry here for $25 and for $132 that were on our bank statement, okay, that were not put on our books. So we have to put them on our books. So I'm going to, let me see if I, I'm just going to write the journal entries over here and just try to squeeze them in. I'm not going to write a description. You can write the description if you want. Look at the descriptions in the solution. But for now, I'm just going to put them here. And, obviously they're all dated, like it says 5/31. Okay. So basically you'd have, 3 entries and each one dated 5/31. So for interest revenue, okay, obviously, that is an we're making, just realize we're making journal entries, okay? And if you look at this and you go, well, how do I make this journal entry? If you go back to how to make, the theory videos on how to make journal entries, there's a video up there on the financial accounting section, how to make a journal entry when you don't know how. This still applies, okay? It's just a thought process. Don't make it any harder than it is, all right? We're looking at our books and we have an entry for interest revenue for $5. If you go through the thought process and you ask yourself, does this affect cash? Well, the answer to this is yes, because I'm adding $5 in cash to my books, all right? So if I'm affecting cash and cash is increasing, that means I'm going to debit my cash, right, for $5. And then I have to credit something else because debits have to equal credits. What am I going to credit? Well, I'm going to credit interest revenue for $5, and that's it. Okay. If you went and said, okay, if you're like, if you're just trying to, you're just look at this interest revenue for $5 and you go, oh, okay, I know I'm supposed to do interest revenue, and then you have to be thinking about whether you debit or credit it. Okay, you might get it right for credit to interest revenue, but then you might be thinking, oh, well, what am I supposed to do? What's the other half of the entry? Because I know that I have to, my debits have to equal credits, and you might be confused as to what the other half of the entry is, okay? Because you're looking at something, you're looking at adjustments here, okay? And you don't have a transaction like you have for a regular invoice, all right? Well, go through the thought process. Am I affecting cash? Yes. So you make the entry to cash, and then you back into the other half of the entry, which is the interest revenue, and you get it right. All right, so now we have our next entry here for this $25. So we date it 5/31. And again, am I affecting cash? Well, if it's a service charge, and remember, we're looking at our check register, which is basically our cash account, right? we're decreasing our cash. All right, so that's a credit to cash for 25, and we have to, debits have to equal credits, so I have to debit something else. What am I going to debit? All right. You have to really kind of like look at your chart of accounts in order to see which account makes the most amount of sense. I mean, is it possible to have a service charge account? Let me write this down. Is it possible to have a service charge general ledger account? All right, so these are going to be general ledger accounts. Yes, it is possible, but it's not likely. It's only a small percentage of the time would you see a service charge account. You're more likely to see it would be called a bank charge or bank fees as an account. All right, if you're looking at your chart of accounts. So it's possible to have a service charge, but most likely you'll probably see something called a bank charge or a bank fees account. And a lot of times you don't even have that, all right? Because why? It only happens one time each and every accounting period, okay? And it's immaterial. The amounts are generally small, okay? So almost all businesses will have a miscellaneous expense account, okay? And quite often you'll end up putting it in, you look at your chart of accounts and you'll see a miscellaneous expense account and you'll put it in there, especially if you don't see a bank charge or a service charge account. I mean, if you see this one or this one, well then yes, you're going to put things like the service charge in those accounts. But in lieu of not having those accounts, you will see a miscellaneous expense account, or you should have one on your chart of accounts, and that's the account that you'll use for something like this. Okay. So we're going to debit miscellaneous expense for $25. Okay, and then you have a non-sufficient fund check, right, of $132. So this is dated 5/31, right? So I ask myself, am I affecting cash? Yes. All right. Is it a debit or credit? It's a credit to cash for $132. Okay. And now I have to debit something else. Okay. Well, what am I debiting? Now notice it says here non-sufficient fund checks. It doesn't say non-sufficient fund charge. Let me try to clarify this here. By explaining it this way. All right, somebody writes you a check, okay? Let's say it's check number 108, and it's in the amount of $350. I mean, this is from XYZ company, right? And they're mailing you this check in payment of their accounts receivable, right? So what happened is when you received that check, you debited your cash and you credited your accounts receivable for $350. That was the entry that you made. All right. Now, the bank says, oh, that check bounced. Right. And because it bounced, you don't have this $350 in there. Right. So that's why, we're reducing our cash balance by, 350. Well, in this case here, let's just make it 132. Sorry about this. So I'm debiting cash for 132, and I'm crediting accounts receivable for 132. I went into theory mode when I started, thinking about, when I wrote this 350, I was thinking theory-wise, I wasn't applying it to the problem here. So let me just change this here since it's the actual number. All right, so, XYZ company had purchased something and you had it on it, but you had they had bought it on account. All right, so you had, when they had originally purchased it, that you debited your accounts receivable for 132 and you credited revenue for 132. All right, that was the original purchase. All right, then XYZ company goes and they pay you for that that purchase. So they send you the check for 108 in the amount of $132. All right. So when you make your journal entry for that, you're debiting your cash for 132 and you're crediting your accounts receivable for 132. Now the bank said, that check bounces. They don't have enough money. And so since it's, you deposited it and that money's not there, you have to decrease your cash. So that's why we're going to credit our cash by 132. Now, debits have to equal credits. So what is the opposite side of that transaction? Well, the opposite side of that transaction is this accounts receivable, right? So we're going to debit our accounts receivable for $132, right? And that's the entry we make for this non-sufficient fund check, right? Now, I went through all of this, but notice I had written a non-sufficient fund charge here, okay, versus a non-sufficient fund check. You have to pay attention to this, all right, because this non-sufficient fund check is, again, it's somebody else that paid you and you deposited it into the bank and their check was bad. So that, that money has to come out. Don't get it confused with a non-sufficient fund charge where your check is bad. Okay, so if you go and you write a check for $350, all right, and that check is bad, all right, the bank is going to charge back your account for the $350 because it's, it didn't exist, and they're going to charge you like a $35 additional charge, right? That $35 additional charge will show up on the bank statement and won't be on your books. So when you do the reconciliation for the bank statement, you're going to see, oh yeah, this $350 bounced, that check bounced, and you have an additional $35 charge that they're taking the money out of your account. Okay, that has to show up on your books. And if your cash is very thin, meaning you don't have any money in your account, you're floating right there around zero. Okay, if you write a check for $350 and it bounces, okay, the bank will charge you $35. And what will happen is that the customer's bank, remember, here's your bank and here's the customer's bank, right? When you send them the check, that customer is going to deposit that $350. And when they do, and it bounces, okay, well, the bank is going to charge you an additional $35, all right, because of that bounced check. But what will happen is the customer's bank will not only try to deposit once, but they'll try to deposit a second time, all right? And if they try to deposit a second time, you're going to end up with another $35 charge. And if your account balance is very close to zero, because of these $35, might put you over to where your other checks start bouncing. So it's conceivable that you might end up with 3, 4, or 5, different non-sufficient fund charges because your balance is very, very close to zero. Okay. So, and then all of these checks just start, bouncing, and you just start racking up these non-sufficient fund charges, and because the charges come out of your account, there's not enough money for your other checks, and it's a cascading kind of thing, where all of a sudden now you've got, $300 worth of additional charges that you didn't expect, and it's making everything bounce all over the place. Because why? Your checking account is very thin in cash. I mean, it's right there at zero. So you need to keep enough money in your cash account in order to keep these things from happening. Okay, how much, that's up to you. Okay, that depends upon your business, how many checks you're writing, so on and so forth. But you constantly have to, in your business, you constantly have to keep an eye out for your cash account to make sure that things aren't bouncing, because one, it creates just so much more work, so many more entries, so much more headache and aggravation, and it hurts your reputation. Okay, you don't want your vendors, thinking, oh, your checks always bounce. Okay, they're always leery of you. They don't want to extend you credit if you don't have that extension of credit. Remember, I mean, they don't really do that much to extend credit. It's not like you have to jump through a lot of hoops like getting a bank loan or something like that. But they can just cut you off, and if they cut you off, that hinders your ability to do business. So you don't want that to happen. All right. So for a short exercise, that was a pretty long explanation. So let me just clean this up a little bit here. All right. So just real quick. Okay. Real quick. These here are your entries, right? This is your first entry, this is your second entry, this is your third entry. Because of, oops, let me come on, because of this entry to your books, this entry to your books, and this entry to your books. Okay, and of course you can put in the description, like I said, look at the solution for that. Right, so that's it for this this exercise, and I will see you in the next video. And if you don't understand something, you watch the video again, or feel free to contact an instructor. Okay.